Welcome back to the Property Finance Podcast. So today I want to talk about investors. So again, kind of going off on a bit of a tangent, not necessarily talking about finance products, but this is essentially how to do your due diligence on people that you want to invest in, because there are so many social media posts out there at the moment. So this is kind of off the back of seeing lots and lots of social media posts of people who have lent property investors, developers money, and they've then just disappeared. And it's really, really difficult because I think the problem is a lot of people do their checking up on Facebook and whatnot, and they'll go through social media, networking events, everything else, and they'll say, "Oh, I'm thinking of lending so and so a bit of cash for this deal, and what do you know about them?" Everything else. The problem is you can get quite a warped sense of perspective, I think, from Facebook and social media, because people will invest with someone, they won't necessarily have been paid their money back, but they'll still give a positive review of that person. And I think that's where a lot of these investors and developers who crumble and kind of disappear with investors' money, I think that's where it comes from, because a lot of their sort of biggest fans tend to be people who've lent the money, haven't necessarily had it paid back, and are just out sort of bigging them up on social media. So you then create this cycle of people wanting to invest because they've heard good things, but not necessarily doing the right checks. And I think there's a lot of things you can do. I mean, the first thing that I would say without a shadow of a doubt is if you're looking at investing in someone, make sure that it's deal specific, because there are all too many people who lend equity based on prospective deals, or they might lend money for legal fees or stamp duty or something like that. It's not actually tied to a specific project. And I think that's the first thing that you want to do, is you want to look and base that investment on something specific and get security on that specific investment as well. So you're not always going to get it. It's not always going to be the case because, for example, we have clients that do development deals. The development finance lender says, we can't allow a second charge. We're not happy with the second charge sat behind us. But there are most deals where you could take a second charge as the equity investor. So I think that's the first thing you need to do, is you need to take the right security. And in order to take the right security, you need to have a good solicitor. All too many times I see equity investors who don't take the right legal advice. They just chuck 20, 30, 40 grand, 50 grand, 100 grand, 200 grand, whatever the figure may be, at someone and say, "Oh yeah, don't worry about it. We won't worry about solicitors. They're too expensive or too time consuming," or whatever it may be. That can't really be the case. You've got to get a solicitor involved. I mean, I'm dealing with one at the minute where we found an equity investor for a developer. It's only a 30 grand loan, but it's still going through solicitors, because even £30,000, it's a lot of money to throw away or to have someone disappear with. So you need to get the right legal advice, make sure that the personal guarantees, the legal charge, everything else are done correctly and done properly. So that's the first thing, is you get a bloody good solicitor on board. And then, as well as taking personal guarantees, as well as taking a legal charge over a specific project, you might want to look at taking a debenture. The only thing I would say with taking a debenture, which is a fixed and floating charge over a limited company, is you might interfere with that company's ability to borrow in the future. So I would only use that as a last ditch attempt, I guess, to get a bit of security, but get that right security in place without a shadow of a doubt. So all your legal documents need to be done properly. All your checkups need to be done properly. You need to have your solicitors do all your anti-money laundering checks. They need to do all of the checks around, obviously, all the documentation, making sure it's executed in the right way, make sure that there's no loopholes, because there's nothing worse than investing in someone and then them finding a loophole within your poorly drafted legal documents and then being able to disappear with your money. So make sure that's all done. And then the last thing I would say is, if you're looking at investing in someone and you've done your checks on them, you're happy with the stuff you've seen on social media, you're happy with the reviews you're getting back from people, you're happy with all the legal documentation, just make sure that those reviews you're getting are from people who have actually been paid back their money. Don't listen to reviews from people who have invested in someone and not been paid back. You want to be dealing with reviews purely from people who have invested money and have had that money back out. Because otherwise it's a dud review. There's no way that you should be listening to that kind of feedback. So as an investor, protect yourself, make sure that you're investing in the right people, make sure that you're completely covered as well, make sure that you've always got the right security in place. Never invest in someone without security, whether it be a personal guarantee. And if you're going to lend on a personal guarantee as well, make sure that there are assets to back that as well. Don't lend to someone on a personal guarantee if they've got nothing in their name, if they don't own their own residence, if they haven't got other investment properties, if they haven't got a car in their name or cash in the bank or ISAs or whatever. Make sure that if you're lending purely based off a personal guarantee, that there is something that you can fall back on. Because again, all too many times we see people invest in investors and developers. They're taking just a personal guarantee and then they've gone to go and claim it back. And actually all that's happened is the investor developer has gone, well, I've got nothing in my name, declared bankruptcy and just called it a day. So just make sure that you are covered on all fronts in that regard. And hopefully, fingers crossed, you should be covered in all eventualities then. As for what you should charge as an investor, it's completely up to you. But what I would say as a rule of thumb is minimum you need to be charging for equity investment is probably 18% per annum on the riskier stuff, because if you're only lending on a second charge, you obviously need to be protected. It's higher risk investment. If you're lending on a first charge, I would say 10, 12% is fine. But if you're lending on a second charge or even just a PG, you've got to be that minimum 18%. So I would say first charge, 10, 12%. Second charge, probably 18% per annum. If you're lending on just a personal guarantee, I think you've got to be above 20% because that is insanely high risk to lend just on a personal guarantee. And then as an investor, there's no reason why you can't ask for profit shares as well. So you may even want to come in as an investor on an earn and learn, for example. So you might charge 12% and a 10% profit split, or potentially, depending on how much you're putting in, you might want more than a 10% profit split. But there are loads of different ways you can structure it. So just make sure you go through all the options. Make sure you do all your research on the person that you're investing into. Just try and keep that money as safe as possible, because there's nothing worse than investing in someone and having them disappear. And hopefully, if people listen to this advice, we will see less and less of these social media posts around investments gone wrong. But yeah, hopefully there's been some tips in there for you moving forward. But thanks for listening. I will catch you on the next one.